You are in your 20s, and someone is telling you to invest, and honestly, it feels completely pointless. You can barely pay rent, and someone wants you to put away $100 a month. But what if I told you that your 20s are the single most powerful investing decade of your entire life, and most people waste it without even realizing it? Let me be straight with you from the start. I am not here to tell you to stop buying coffee or eating out. I am not here to make you feel guilty about how you spend your money. Because the truth is, feeling like investing is pointless in your 20s makes complete logical sense. You put in $100. A whole month goes by. You open the app, and your account went up by $8. $8 for an entire month of sacrifice. So you think, what is the actual point of this? I could have used that $100 for something real, something I can see and feel right now. And so you stop investing. Or maybe you never even started. And that feeling, that completely reasonable and understandable feeling, is quietly costing you hundreds of thousands of dollars, not in some vague future way, in real numbers that I am going to show you right now. Because the lie is not that investing feels pointless in your 20s. The lie is that it actually is pointless, because it is the complete opposite. Your 20s are where the entire financial game is won or lost. And today, I am going to prove that to you with real math. Why it feels pointless. Let me explain exactly why your brain keeps telling you that investing is not worth it right now. It is not weakness. It is not laziness. It is just the way every human brain is wired. Our brains are built for short-term thinking. We feel today's pain very clearly and very immediately, but we feel tomorrow's reward in a very foggy and distant way. So when you invest $100 today, the pain hits you instantly, and it is real. That is $100 you cannot use for food, for going out, for something that feels good right now. But the reward, the $40,000 that same $100 eventually becomes, is 35 years away. Your brain genuinely cannot feel that. It cannot picture it. It does not feel real at all. And so your brain makes a very logical short-term decision: skip it. Enjoy today. Deal with the future when it gets here. This is called present bias, and every single human being on the planet has it. Wealthy people are not immune to it either. The difference is that wealthy people built a simple system that removes the decision from their brain entirely. They automate their investments, so the money moves before they ever get a chance to spend it. That one small habit, automating your investment, is honestly worth more than any fancy investment strategy out there. But let me first show you the real cost of waiting. The real cost of waiting. I want you to read this part slowly, because these numbers are completely real and they will change how you see your 20s forever. Meet two people. Let's call them Alex and Jordan. Alex starts investing at 22 years old. He puts in $200 every month into a simple S&P 500 index fund, earning 10% average return per year. He does this for exactly 10 years, from age 22 to age 32. Then he stops completely and never invests another single dollar for the rest of his life. Jordan starts at 32. Same $200 a month. Same 10% return. But Jordan keeps going all the way until he is 62 years old. That is 30 full years of consistent investing without stopping. So Jordan invested for 3 times longer than Alex. Jordan also put in 3 times more money in total. Who ends up with more money at age 62? Alex, the one who stopped at 32, ends up with around $1,011,000. Jordan, the one who invested consistently for 30 straight years, ends up with around $452,000. Alex wins by more than double, even though he stopped investing 30 years earlier. Even though he put in far less money overall. The only reason Alex wins is because he started 10 years sooner. Those 10 years in his 20s, the exact years when investing felt completely pointless, were worth more than Jordan's entire 30-year investing journey. Your 20s are not a warm-up round. They are the main event of the entire game. The math behind the magic. Let me show you exactly why starting early is so incredibly powerful, because it all comes back to compound interest. When you invest money in your 20s, it has 40 or more years to compound and grow. And compounding is not a straight line, it is exponential. The growth gets bigger and bigger the longer you leave it alone. Here is a simple example to make it concrete. You invest $5,000 at age 22 and never touch it again. At 32, it is worth $12,969. At 42, it is worth $33,637. At 52, it is worth $87,247. At 62, It is worth $226,296. Now look at what happened in just the last 10 years. From age 52 to 62, your money grew by $139,000 in a single decade. That final explosion only happened because you planted the money at 22. If you planted at 32, instead, the entire chain shifts forward, and you completely miss that final massive growth phase at the end. Your 20s are not about seeing big results right away. Your 20s are about planting seeds that explode with growth 30 years later. The patience problem here is the honest truth about why most young people quit investing before it ever gets good. You invest for 1 year, 2 years, 3 years, and the numbers barely seem to move. You are putting in real money and making real sacrifices, and the account looks almost exactly the same as when you started. So you think this is clearly not working, and you pull the money out, and you spend it, and somewhere down the road, you start over from zero. And that pulling out and restarting that single decision completely destroys the compounding chain you had already built. Compound interest needs one thing above everything else. It needs uninterrupted time. Every single time you pull your money out, you reset the clock back to zero and lose all those years of quiet, slow growth. So the skill that matters most in investing is not picking the right stock or timing the market perfectly. It is simply leaving your money alone and letting time do what time does. Boring, completely unglamorous. Not something you can post about, but more powerful than any investment strategy ever invented by anyone on Wall Street. What young investors get wrong, let me walk you through the most common mistakes people make when they are just starting out in their 20s. The first mistake is waiting until they have more money. I will start when I earn more. I will start after I pay off this debt. I will start when I have a proper emergency fund. There will always be a reason to wait, always. And every month you wait is a month of compounding that you can never get back. $50 a month started at 22 becomes over $50,000 by age 62. The same $50 a month started at 32 becomes around $18,000. Same money, same effort, completely different outcome just because of when you started. The second mistake is checking the account too often. When you are young, and investing small amounts watching your account every day will absolutely destroy your motivation. Up $12, down $30, up $8. It looks random and pointless. But zoom out and look at the 10-year chart, and the line goes consistently and powerfully upward. Checking your account every day is like pulling a plant out of the ground every morning to see if the roots are growing. You are disturbing the very process you are trying to protect. The third mistake is trying to pick individual winning stocks. Everyone in their 20s wants to find the next Amazon or the next Apple. But almost everyone who tries this loses money, including professional fund managers with entire teams of analysts who still cannot beat a simple index fund over 20 years. Keep it simple. S&P 500 Index Fund. Automatic monthly investment. Leave it completely alone. That is the entire strategy.